Hi, good evening to everyone. Welcome to our monthly market outlook. We have many things to cover today, but obviously the starting point is US, Israel, and Iran conflict, which is raging since 28th of February. Energy is multi-source: coal, oil, gas, nuclear, hydro, and renewables. But oil and gas yet contributes almost half of global energy. Oil and gas are free flowing. This chart shows how LNG moves from one part of the world to another part. Unfortunately for the world, oil and gas both are concentrated in certain parts, including Middle East. The Strait of Hormuz, lying between Iran and Oman, allowing Saudi, Iraq, Kuwait, etc. to export their oil and gas, is a choke point. It is the second biggest choke point for movement of energy. Roughly 20% of global energy consumption from oil and gas, or 21 million barrel, passes through Strait of Hormuz. Strait of Hormuz has seen big drop in movement of ships. It has corrected from 100 plus to single digit number. And while there are other options, they are relatively small. Saudi Arabia, almost 50 years back, built a pipeline to transit oil to Red Sea, and it can pass about 7 million barrel through Red Sea or Strait of Bab al-Mandeb. UAE did build a small pipeline bypassing Strait of Hormuz, but the capacity of that is not huge. This makes this Strait of Hormuz a choke point for all the oil coming from Iraq, Kuwait, Saudi Arabia, Qatar, and UAE. In last 30 days, the world has witnessed one of the largest disruption in oil and gas supply. When the Iraq invasion happened in Kuwait, the hit to supply was about 8 million barrel, which was Iraq's production. This time hit to supply is 16 million barrel, which is combined production of Iraq, Saudi Arabia, Kuwait, Qatar, etc., which has been impacted by closure of Strait of Hormuz. The price change is less compared to 1990, but it is still substantial. This obviously has resulted into freight costs jumping up. If we include potential premium or toll charges paid by shippers to Iranian agencies, the number could be even further higher. A direct impact of closure of Strait of Hormuz is urea prices. Urea is produced out of natural gas. Qatar is roughly about 40% of global LNG production. As supply of gas comes under pressure, fertilizer production comes under pressure. There is also impact on allied sectors, from petrochemicals to chemicals to plastics to packaging. Even shortages of helium, where Qatar is a very large producer at almost 1/3 of the global production, can impact semiconductor chips or even routine MRI scan in hospitals. The persistent oil prices can lead to recession globally. We have seen that in the 90s, in the 80s, Iranian Revolution, in the 90s, first Gulf War, then the Asian crisis and dot-com bubble, then COVID Ukraine war. So clearly, whenever oil prices go higher, global growth suffers. Obviously, different countries are exposed to energy shock differently. Countries like Malaysia, Australia, which are independent on energy as they produce enough at home, are far less vulnerable. Thailand, Singapore, Korea are more vulnerable, but many of them have built strategic petroleum reserve. India has reduced its vulnerability, but we are still vulnerable. The Gulf countries where about 5 million Indians, about 9 million Indians work, they are also going to take a hit on their economy. Many of them have started cutting salaries of employees, especially in tourism and travel sector. So even Gulf countries will suffer because of this geopolitical crisis. There is a Gujarati saying which says, Dukarma Adhik Mas. When there is famine, there is also an additional month. The Australian LNG production has been halted because of a cyclone and its consequent impact. This has impacted about 8% of global supply. So not only Middle East, but also Australian supply got impacted. On top of it, we are dealing with President Trump. I have often said, Dawn ko samajhna mushkil hi nahi, namumkin bhi hai. And the way he has moved from one position to another, on one side talking, other side throwing back them to the Stone Age, one doesn't know which way President Trump is thinking. Is he for escalation? Is he for de-escalation? Is he for bombing? Is he for settlement? It becomes very, very difficult. This cartoon obviously is in lighter vein, but in the White House, there is rumor that people are doing insider trading with that kind of verbal positioning. What is the silver lining among the dark cloud? And please remember, this is trying to be optimist. Well, the European crude Brent futures are in backwardation. They believe this war is likely to be temporary. It will keep oil prices higher for next couple of months, 2, 3, 4, 5, 6. But thereafter, oil should start coming down. It should not go back to 60, 70, but certainly it can be in the 70, 80 handle. Let's hope and pray this proves true. Obviously, this are market, it can change overnight. But if this proves true, then there is hope for Indian economy in second half of FY27. Coming to global economy, no price for guessing that everyone is revising growth forecast down. The 2026 calendar year global growth forecast is down by about 40 basis points, led in developed markets and also emerging market. We believe there is more downside to this growth projection as the war gets prolonged. The PMI numbers across various countries have started factoring in slowdown. It shows disruption in supply chain is creating impact across the globe. This is coming at a time when global debt of the government and corporate and household is increasing rapidly. Now it is roughly at about 330% of the GDP. Sorry, it's roughly about $330 trillion and roughly about 310 as a percentage of GDP. Obviously, this debt is led by government. US has the highest debt at about 39 trillion. Europe is at about 18 trillion, and China is matching Europe. We saw subprime crisis in 2008 that originated from subprime housing loans given to weak hands in the economy. Something similar is brewing in private credit. Many of the large established private credit funds have stopped redemption, just like what one of the mutual fund did during COVID crisis in India. Now, is this problem which will be contained, or is it something like subprime which may scale across the globe? We'll have to monitor. Now, as inflation starts rising, will interest rates be cut or will interest rates be raised? At this point of time, it looks like most central banks will be on hold, waiting and watching how things are changing, and market yield in anticipation of higher inflation and continuing supply chain disruption may start moving on the higher side. The bond markets across the globe, including in developed world, is relatively in weak positioning, or as we call vulnerable because of high level of debt. The other point which people will have to look at is Taiwan. US defense forces are committed to Iran. Their arms and ammunitions, rockets and missiles are coming to stretch. And today, US imports more goods from Taiwan than China. Does this situation embolden China to make a move on Taiwan? The world certainly does not have ability to manage two geopolitical crises, one involving China, Taiwan, and second involving Middle East and Israel and America at the same time. What is the silver lining among the dark cloud in global economy? Well, renewable energy is finally getting the push it deserves. And now we are adding roughly about 650 gigawatt of solar capacity on an annualized basis. That's almost 1 gigawatt of capacity every half day. Long gold and long global semiconductor appears to be a crowded trade based on the fund manager survey by BofA. This geopolitical situation is pushing asset allocator to some illiquid as well as alternate assets like global agriculture ETF. Due to urea shortage and supply chain disruption, people believe agriculture commodity prices will go higher, and hence monthly flows have increased substantially in global agriculture ETF in the month of March. What other silver lining we could look among dark clouds? Well, once the crisis is over, markets invariably recover. We saw that in COVID crisis. Hopefully, once this crisis is behind, markets will see bounce back. China is perceived as someone who has taken preventive measures to safeguard their economy. Undoubtedly, China made a pivot from real estate to industrial sector. They spent trillions of dollars to build their manufacturing capability. It pushed China to be one of the largest exporter of automobiles, overtaking Japan, Germany, South Korea, and US. Despite rampaging car sales by Chinese automobile companies globally, in China, Volkswagen captured 14% market share and remain the topmost auto manufacturer in China. Exports for China has been supportive to growth led by auto, whereas real estate has continued to weaken because of the excessive speculation of the past. Many provinces in China have revised their growth numbers lower. Many have cut their target GDP growth. It shows that while on face of it, Chinese economy is not impacted by Middle East crisis, reality could be different. To some extent, China is having excess capacity, and despite their dumping goods across the globe, capacity utilization has started declining as excessive capacity is not being, they are not able to run those capacities to the fullest extent. This is also reflected in LNG imports of China. Like other parts of the world, their import has declined because of supply chain disruption. Chinese government revenue also seems to be flattening out at about 25% of GDP. It's moving in that band almost since 2010, and post 2016-17, it has seen marginal decline. The impressive part of Chinese economy is their spending on research and development. It is expected that over next couple of years, China will overtake US in terms of R&D funding. Undoubtedly, China is planning for future. There is maximum number of nuclear reactors under construction in China. What do we look forward in China? Well, in last almost 20 odd years, Chinese markets have gone up 5 times and come down 5 times. This is 6 times they are going up. Let history repeat. If Chinese markets correct for any reason, beneficiary will be Indian market. Coming to US economy, well, there is surge in AI investment, in chips, in GPUs, in data center, in power. Everything related to AI led by hyperscaler is resulting into billions of dollars of capex, and that is supporting American growth. $2 billion. The growth in US in third quarter September 25 grew at 4.4%. It moderated in fourth quarter at about 1.4% despite large AI investment. As I mentioned earlier, US debt continues to pile on, and now it's roughly about $39 trillion. The good part for US is that they are the largest producer of crude in the world at about 14 million barrels per day. Their equation on energy is almost neutral, as export, import, consumption and production kind of balances out each other. In this context, yields have gone up across the in this context, dollar has strengthened against global currencies, and compared to rest of the world, interest rates have moved in US by about 34 basis point, much lower than countries like UK, Brazil, and South Africa. But the most important part is dollar appreciation against majority of global currencies. This is how DXY bounced from the bottom 98 to about 100.5. The strength of dollar is also supporting American economy. In US, whenever oil prices have gone up, it has pushed up American inflation, and by and large, Fed has reacted by raising interest rates. As you very well know, current Fed chairman term will come to end around May 26, and new Fed chairman Kevin Walsh, already nominated by President Trump, will take over as Fed chairperson. The markets have reacted to the global events, and we have seen one of the largest outflow in US equity in last month or so. The biggest question for US obviously is not geopolitics, it is artificial intelligence. And is the current Max 7 bull run looking like Nasdaq TMT bubble? The answer is clearly no. There is far better balance sheet. The TMT bubble was funded through weak balance sheet. That's not the case today. Even from capital allocation efficiency, this company's Max 7 seems to be doing well. So despite correction in recent times, it doesn't look like that this companies are bubble like 2000 TMT era. Coming to Indian economy, headlines have been mixed. The past is good, the future is uncertain. Historically, in India's Kundali, Rahu Kal starts when oil prices go higher, and every time oil prices have gone higher, there has been knockdown impact on GDP. Crude prices have shot through the roof in last 1 month, and that's witnessed even in LNG. We are one of the most vulnerable economy because of higher import of energy and lower production of energy. About 1/3 of our gas supply is disrupted. Focus has been fertilizer plants, focus has been cooking gas, and the sufferer has been industrial sector. Government under PM scheme delivered many cooking gas connection to the rural economy. Ujjwala scheme removed burning of wood, coal, and consequent smoke from the rural households and gave them clean option of gas-based cooking. Unfortunately, that has increased our consumption as well as import needs. With supply chain disrupted, undoubtedly there is queue for LPG demand. Hoarding nature of Indian also didn't help us. Earlier, there were 55 lakh cylinders ordered in a day. Thanks to the hoarding, it went up to 75 lakh cylinders a day. Undoubtedly, that also impacted supply. Our LNG imports have doubled over the last decade as production has remained almost flat and demand has kept on increasing. Natural gas is base material for many industry like power, fertilizer, petrochemical, some industrial and manufacturing. Any disruption over here has multiplier effect across India's economy. Crude is base material for many industry, and different industries have differential linkage to crude prices. Something like metals is impacted far more vis-a-vis, let's say, banking and financial services. For us, the biggest need of monitoring current geopolitical crisis is driven by presence of more than 9 million Indians in Middle East. Their safety is our priority. They also send about $50 billion of remittance to India, and clearly any impact there will have impact on our rupee and trade balance. The remittances form large part of economy of Maharashtra, Kerala, Tamil Nadu, Telangana. These states can get impacted if there is drop in remittance. The government has cut excise duty on petrol and diesel to safeguard consumers, but there will be hit on the fiscal side because of this cut. The oil sensitivity of Indian economy has declined over last 20 years, but it still remains a reasonable mover of Indian economy's fortune. We do have FX reserves to pay for higher imports or fund larger trade deficit, but undoubtedly RBI is also short forward by 60 to 70 billion dollar. Despite US tariff this year, which resulted into exports to US coming down, rest of the world has seen bounce back in India's exports, and thus our current account deficit without the impact of war is in reasonable shape. With all the pressure of FPI outflow, higher crude prices, RBI's forward dollar shorting, rupee depreciated and crossed 95 barrier. Thanks to the corrective steps taken by RBI, it has come down to 93 plus handle. IMF has revised growth projection in India as well as China, courtesy geopolitical impact. For us, bigger challenge remains AI. About 4 crore Indians directly or indirectly work in BPO, KPO, GCC and IT exports. $350 billion worth of revenue is generated by them in foreign currency. That revenue helps us import oil and other items. Any slowdown in IT related jobs will have material impact on India growth story. If we capture in 1947, when we got independence after 200 years of colonization, Britishers had sucked India dry. For almost 200 years, our growth rate was near zero. Despite all those colonization, loot, India was roughly about 18.7% of global per capita GDP. Indians were about $95 per capita GDP against global average of 454. Throughout 60s to 90, 30 odd years, Indian economy continued to grow in low single digit. World continued to grow in double digit or high single digit, and hence our per capita GDP as a percentage of global average fell by more than two-thirds to about 6.5%. World moved from $454 to $4,665, and we moved from $95 to 303. We moved forward, others raced ahead of us. Post 1992 liberalization, per capita GDP started improving. Indian economy opened up, become market driven, and today, against global GDP, per capita GDP of about $15,280, we have reached $3,000, roughly 20% higher than what we were in 1960. This roughly summarizes India's growth story of last 70 years. Coming to equity market, well, large, mid, small, everything has corrected courtesy this geopolitical crisis. Surprise was small and mid cap outperforming large cap, but that's more driven by few stocks. But otherwise, broad market has corrected. Sectorally, real estate, tourism, banking and financial services, auto has been hit hard. Pharma, IT, energy and metal have been relatively stable. Market cap to GDP ratio has come down from 129% in FY24 to 115%. It is still higher than historical average of 87%. The fall in mid and large is fairly high. Mid and small is fairly high compared to large cap index. The median fall in small cap at about 36% is far higher than large cap drop at about 21%. We continued to manage our funds on a conservative basis. We didn't take cash call, but through superior stock picking almost across all our fund, we have fallen less than the benchmark index. If we look at profitability growth for FY27 and FY28, it's likely to be driven by automobile sector, banking sector, and diversified financials. Sectors like pharma and IT may just show flat growth of profit in the days to come. Metal and mining probably will see revision upwards, and oil and gas profit growth will depend upon what is the government policy, how much profit they keep in upstream oil company, and how much losses they pass to downstream oil company. Aggregate PAT of listed India is roughly about 5.3% of GDP. That is certainly near all-time high level seen during FY7, FY08. So chances of significant increase in profitability through margin expansion looks difficult over here. This is the estimate of Nifty 50 and MSCI earnings growth before the geopolitical events. I'm sure there will be revision downwards in this estimates. FPIs have been sellers after selling about $19 billion in CY25. The first 3 months of Jan, Feb, March, selling has almost touched $14 billion. This selling is driven by the fact that India underperformed rest of the emerging market. Korea, Mexico, Brazil, they all did better compared to MSCI India. Today, MSCI India's PE relative to MSCI emerging market is at 16-year low, bearing 2017. Undoubtedly, investors who have invested at this low valuation should have and have benefited. At one point of time, India was about 4.6% of global market cap. Today, it is around 3%, a marginal premium to its long-term average of 2.8%. The DII flows, thanks to investors and distributors like you, have continued. In the month of March, we saw DII investment of almost $15 billion as FII selling stepped up. Valuation-wise, now large cap index at 16.9 is below historical average of 18.6. The small cap index at about 20 times is slightly above historical average of 17, and mid cap index at about 24 times is slightly higher than historical average of 23.6. Large caps are now at a discount to historical average. Small and mid cap are at marginal premium. We have continued to deliver better than index return through stock picking. For example, flexi cap SIP returns between October 24 to Feb 26 is about 6.5%. The Nifty 500 is down by about 11.3%. While this return looks red, it has generated alpha of 4.8% to 3.4% depending upon which benchmark index you choose. Across funds, we have aimed to deliver outperformance over benchmark index. What can one say at today's market? Well, pray and be ready for volatility. Whether we like it or not, President Trump will continue to do what he wants to do, and that will create volatility in our market. कभी ऊपर कभी नीचे, कभी खुशी कभी गम, ये चलता रहेगा. One summary is that by and large market bottoms out well before war ends. In Kargil war, market bottomed out in May 99, actually when the war began, and by the time war ended in July 99, Nifty was substantially higher. In the invasion of Iraq, market more or less remained flat, though it bottomed out in April 2003. Russia-Ukraine war, undoubtedly in Feb 22 market was higher, but it bottomed out in somewhere around June 22. So market tries to discount future and bottoms out well before war has come to an end. Our Recommendation: correction is an opportunity to add in a calibrated manner. If you are risk averse or conservative investors, then be neutral weight to equity with large cap overweight, small cap underweight, and mid cap marginally overweight. If you are aggressive risk taker and you believe President Trump will surprise us by a ceasefire announcement, then you can become overweight equity on a marginal basis at this valuation. Our funds continue to add alpha to our investors by consistently performing across debt and equity fund on a point-to-point basis, also bearing small cap and mid cap fund. Across majority of time period, we have delivered alpha. In small cap fund, alpha is negative because we are unable to invest in two kinds of companies. One, MCX, that stock is up 7 times in last 3 years, and by regulation we can't buy shares there. All our peers carry that share in their portfolio and benefit from the price rise. Unfortunately for us, as a group, we are not allowed to invest in Kotak, in MCX. The second, we are waiting for RBI approval to invest in banks: AU Finance Bank, South Indian Bank, City Union Bank, Jammu and Kashmir Bank, and Federal Bank. We have applied to increase our holding in these 5 banks. That has been delayed, and that also results into underperformance. So small cap underperformance is not because of our portfolio calls had gone wrong, but mainly because we couldn't invest under regulatory constraints. Across our other equity funds, we have been able to add value to our investors across most time periods. And even on an SIP bearing small cap, we have been able to deliver value to our investors. Kotak Flexi Cap is one of our flagship fund. It has gone through ups and downs over the years, but it has consistently added value to the customer's portfolio. Kotak Multi-Asset Allocation Fund invests across debt, equity, and precious metal, and it has skillfully navigated all the asset classes to deliver 6% alpha since inception. Kotak Multi-Cap Fund invests across large, mid, and small, and again it has delivered alpha of almost 7% on a rolling return basis. On passive side, our portfolios continue to expand, be it large, mid, small, or on a smart beta of momentum, low volatility, alpha, value, quality, equal weight, and multi-factor passive fund of fund. We also have various sectoral and thematic ETFs and index funds like financial services, IT, consumption, housing, multinational tourism, PSU, commodity, and chemical. And on precious metal, we run gold, silver, and a combined fund of gold and silver. At this point of time, we think Nifty 50 and Nifty Next 50 are passive funds to consider. On a smart beta side, low volatility and equal weight could be appropriate. On commodity, while it is written silver over here, our view is gold. We think gold has potential to deliver better return. Please make correction over here. And sector and thematic, consumption and bank is something which we are recommending. On the fixed income side, US inflation is above Fed's target level and has started inching up on a core basis as higher crude prices at petrol pump and diesel pump starts impacting inflation. Fed earlier was expected to cut rate 3 times in CY26. Now that rate cut possibility has become zero. Crude is Rahu Kal of Indian economy. As crude prices go, GDP growth comes down, inflation goes up, current account deficit widens, and rupee is pressurized to depreciate. Our inflation trajectory was comfortable with one point of time in November 25. It is almost touching zero. From there, it has bounced back. So a lot of bad news is factored into inflation already. Going forward, we expect RBI to revise their inflation target from about 4% to 4.5% or 5% in this credit policy to be announced tomorrow. The inflation scenario does get impacted by higher oil prices, but compared to the past, we are in a slightly stronger position. Rupee continues to depreciate. It has now become more undervalued vis-a-vis our peer group. This depreciation is driven more by technical factors like RBI's forward short position in the market than by the fundamentals. As I mentioned, RBI is short in the forward market to the extent almost $60-70 billion, and that is pushing speculators to continue to attack rupee. While we do have large FX reserves of almost near $700 billion, a reasonable portion of that is gold and special drawing rights, and thus our ability to defend by spending dollar is slightly restricted. The 10-year yield consequently has gone up and crossed 7%. We believe everything depends upon Middle Eastern situation, as rupee and rates both continue to remain at risk due to rising oil prices. RBI in the past has raised interest rates to support rupee, and hence it will be extremely important to see what commentary is given by Reserve Bank of India governor tomorrow in the monetary policy. They have managed liquidity quite reasonably well despite intervention in currency market taking away the money. They have pumped liquidity through open market operation and through some purchases of FX. Monetary policy transmission is patchy, while repo rate and bank lending rates have been cut by 125 basis points. The deposits and the loan market has discounted it partially, not fully. In the debt, income and arbitrage fund continues to look attractive as it carries 12.5% tax post 24-month holding. Someone looking for safe or less volatile return can consider this fund for their portfolio. Gold, it has been on a tier run since 2020, bearing 2021. Silver did well in CY25 and then corrected in this year. Globally, thanks to the aggressive buying by central banks and the price appreciation, gold has crossed US Treasury as the largest holding in global central bank balance sheet. Last 3-4 months, gold prices have corrected from $5,500 to $4,600. Probable cause has been selling by central banks like Turkey, like Poland, like Russia, and also non-buying of gold by the central banks of India, China, and Japan. So central banks who were buyers became sellers, and central banks who were buyers didn't buy as much. This resulted into gold prices correcting. Do remember my analogy? We are running a speedboat ahead of the oil tanker behind. As long as it is coming behind us, we continue to move forward. If it takes a U-turn, we take a U-turn. If it stops, we stop. Undoubtedly, we'll have to watch what central banks are up to and how they are buying or selling precious metal. That will determine what happens to the precious metal prices. In this whole chakkar, China remains a mystery player. They don't disclose what they are doing, and hence many a times it might be better to assume that China is doing exactly opposite of what is visible. As gold prices corrected, flows into global gold ETF also came down, and from 120 tons demand last month, gold demand fell to 26 tons, impacting prices. We believe gold prices are linked to US interest rates as well as US dollar. Dollar weakens, gold prices go higher. Interest rates come down, gold prices go higher. Near term, both near term dollar is likely to weaken, and US interest rates are likely to come down, and that should be supportive of gold prices in days to come. There is also zero discovery of new gold mine, which hasn't happened in the past, and that could also support gold prices. Gold demand should continue to maintain momentum driven by central banks, individual investors, and ETF. That is the forecast. We'll have to see how things are shaping up. In the past also, gold prices have consolidated before moving up. Maybe gold prices are consolidating for an up move over a period of time. Silver is witnessing large correction from $115 before the beginning of the war. It has corrected by almost 40% to $70. If I have to summarize, this is the most important slide of the presentation. In our multi-cap, as suggested, we are overweight large cap, marginally overweight mid cap, and or almost equal weight mid and small cap. In terms of asset allocation, we are slightly on the higher side of equity across our balance advantage fund, equity savings fund, multi-asset allocation fund, as well as fund of fund. On gold, we remain more bullish compared to silver. Sectorally, auto, healthcare, cement, Banking and financial services should do well in the days to come. The funds in focus remains Kotak Multi-Asset Allocation, Kotak Multi-Cap, and Kotak Flexi-Cap in today's environment. We continue to engage you with weekly blogs. We are seeing good media coverage. These blogs are available in audio format also, and it covers various interesting topics from IPL match to space race and from precious metal to stable coin. Do read this weekly blogs and circulate with your co-branding to your investors. Our sectoral presentation has been really appreciated by investors and experts across the country. When we presented on data center, Real Estate Association called us to share it with their members. In defense sector presentation, some of the defense company came back with queries about our view on the future. Do look at this sectoral presentations to deepen your understanding of stock market. Various communication continue to get circulated. I know it's an overload of information, but whenever you get an opportunity, do try to read this curated communication. Our campaign for FlexiCap also got noticed as we pitched FlexiCap as हौसला है तो हो जाएगा kind of positioning. With this, I will end my presentation, but happy to take your questions with my colleague Rohit, who manages Kotak Large Cap, Kotak Quant and Balance Advantage Fund, and Deepak, who is overall Chief Investment Officer for Fixed Income. You can write your questions in Q&A session, and I'll be more than happy to answer that. Is lump sum suggested or STP? If STC, then how or many months or weeks? Undoubtedly no lump sum at this point of time. As I mentioned, डॉन को समझना मुश्किल ही नहीं, नामुमकिन भी है. Please do STP. Please do STP for at least 6 months. And if there is end to the war, maybe you can prepone your STP and convert that into lump sum. But certainly no STP till such time we have clarity on end of the war. Manish Hathi has asked a question on small cap fund performance. Manish bhai, if I remove two regulatory constraints of not able to invest in MCX and not able to invest in 5 banks, our performance